Welcome to the deep dive. Today, we are looking at a real puzzle in the U.S. stock market. It's a moment of just extreme contrast.
It really is.
On one hand, you have this incredible euphoria. The S&P 500 is soaring, right? It's trading near, 6850 as of late December 2025? Just relentless momentum.
And that momentum isn't coming from nowhere. It's fueled by very powerful belief and almost dogmatic optimism that artificial intelligence is a genuine game changer.
A structural shift.
A huge one. The market is betting it will unleash massive productivity gains, massive margin expansion, and that those future gains justify basically any price you pay today. It's the new era story, and it's maybe the strongest it's ever been.
But, and this is the reason for this deep dive, when you peel back that layer of euphoria, when you look at the mathematical bedrock, the historical gauges that have been right time and time again.
They're telling you a completely different story.
A terrifyingly simple one. We're here to look at two of the most respected valuation metrics out there, and both are flashing historical red. They're suggesting all this prosperity is resting on, dangerously thin ice.
We're seeing a dual warning signal you almost never see at the same time.
Okay.
The first is the Buffett Indicator, which compares the whole market's value to the economy's output. That has blown past 224%.
224.
And the second, the Shiller-Cape-E ratio, which smooths out earnings over a decade, has now surpassed 40 times cyclically adjusted earnings.
These aren't just high numbers. This is the 99th percentile of historical extremes?
Exactly. These are nosebleed levels.
Okay, let's unpack this. The question isn't just how high these numbers are. The real question is, what happens when the two most trusted gauges in finance are screaming danger, and the market just, decides to ignore them?
What's keeping this thing inflated? And what are the specific triggers that could pop it as we head into 2026?
That's our mission today. Reconciling this unstoppable momentum with the pure mathematical gravity of these valuations.
And we have to ask, is it possible that this AI revolution really is strong enough to rewrite the laws of financial physics?
Right. Let's start with the one Warren Buffett himself prefers, the big picture metric.
The size of the whole economic pie.
Let's talk about the Buffett Indicator.
Let's do it.
So, the Buffett Indicator is famous because it's so simple. It's intuitive, the logic is almost Newtonian. Can you walk us through the exact calculation? How does it tell us the market is valued at more than 2.25 times the entire U.S. economy?
At its core, it's a very simple idea. The stock market just cannot, in the long run, grow permanently faster than the underlying economy that supports it.
The claims can't outgrow the source of the value.
Precisely. So the methodology is just a ratio.
Yeah.
You take the total market capitalization of U.S. stocks, we usually use the Wilshire 5000 as a proxy for that, and you divide it by the gross domestic product, or GDP.
And what are the latest numbers that get us to this historic peak?
As of late 2025, the figures are really just staggering. The numerator, the total market value of all publicly traded U.S. companies, is sitting at about $70.68 trillion.
70 trillion.
70 trillion.
Yeah.
And that massive number is being divided by an annualized U.S. GDP of roughly 30.77 trillion.
So 70.7 trillion versus 30.8 trillion, that's a gap of almost $40 trillion that the market is essentially pricing in today as future growth.
That's exactly right. And when you do the math, you get a headline ratio of around 229.7%. Now, some models will show it a bit lower, maybe 224, depending on how they lag the GDP data. But we're firmly in that 224 to 230% range.
Which is just a historic supercycle.
Oh, no question.
And we really have to remember where Buffett himself drew the line on this. He was not subtle about it back in 2001 when he first wrote about it.
Not at all. He laid out very clear zones. He said the buy zone, where you could expect really strong returns, was when the ratio was between 70 and 80%. That was cheap.
Okay.
But once the ratio started getting close to 200%, he called that the warning zone. He said investors were, and this is a direct quote, playing with fire.
And here we are, 24, maybe 30 percentage points above the playing with fire threshold. We're in a territory with no historical precedent for sustainability.
We are. The market is trading something like 76% above its long-term exponential trend line. Now, that trend line already accounts for the market growing a little faster than GDP over time.
Right, that's normal.
But a 76% deviation from that trend, that's not a normal fluctuation. It suggests a really deep structural imbalance. Market optimism has just completely detached from the underlying economic reality.
Let's try to ground this 224% figure in some history, because
Yeah.
I think a lot of investors hear that and they think, okay, it's high, but maybe it's like the late 90s.
And that's where the comparison gets really uncomfortable for the bulls. The current valuation just redefines the upper limit. Let's look at the dot-com peak in 2000. That was a period of, genuine mass euphoria.
Total mania.
Total mania. And at the absolute peak, the Buffett indicator hit about 159.2%.
159. So today we're at 224. They were at 159. That's a 65 percentage point difference.
It's a massive gap. And remember what happened after that 159 peak. The S&P 500 crashed by 49%.
Wow.
So the key insight here is that today's market is valued almost 45% higher relative to the economy than it was at the very top of the dot-com bubble. That suggests this isn't just a tech problem, a sector problem. It's a systemic valuation issue across the board.
And what about the more recent peak, the stimulus-fueled peak in 2021? That felt really intense at the time, but we've blown past that too.
We have. That peak, driven by 0% interest rates and, just unprecedented fiscal stimulus, pushed the ratio up to between 189 and 200%.
And what happened next?
The 2022 bear market. The fact that we've accelerated past that 200% mark and added another 24 points on top of it suggests that the current AI narrative is arguably even more powerful and more embedded than the internet was in 1999.
Okay, so whenever history is flashing this red, the market finds a reason to say this time is different.
We have to really dig into the three main arguments that are being used to justify this 224% level.
Absolutely. Let's start with the most common one.
The globalization argument.
The globalization mismatch, right? But the argument is that the indicator is flawed because U.S. companies have gone global. The numerator, the market cap, reflects global revenues, but the denominator, GDP, is only domestic output.
And U.S. companies make something like 40% of their revenue overseas.
Exactly. So the argument goes that the numerator should just naturally grow faster than the denominator. And on the surface, that sounds really compelling. If our companies are winning globally, their value should outpace the U.S. economy. Does the math actually back that up?
It backs it up as a partial explanation, but it falls way short of a full justification. To correct for this, what we can do is adjust the denominator. Instead of GDP, we can use gross national product, or GNP.
And GNP includes that overseas income.
It does. It includes all the income earned by U.S. residents and businesses, no matter where in the world it was earned. So it captures the full economic footprint of these U.S. corporations.
And when we make that switch from GDP to the more comprehensive GNP,
the ratio is still incredibly high. It's at 215.7%. So what this tells us is that, yes, globalization probably justifies a ratio that's structurally above 100%. Maybe 120, 130.
but not 215.
Not even close. It is fundamentally insufficient to explain this huge deviation. The systemic gap is still there.
Okay, argument number 2. The margin expansion thesis. This one says that U.S. corporations are just better at making money now. They're capital light, tech-driven, and more profitable.
And the data, to be fair, backs this up. S&P 500 net profit margins have risen from their historical average of around 6 to 8% all the way up to a stunning peak of 16.4% in late 2025.
So more than double the historical average.
Yes. And if companies can consistently pull more than twice the profit out of the same level of economic activity, you could argue that justifies a higher valuation.
But this is where the idea of mean reversion comes in, because those peak margins are incredibly fragile. What are the biggest threats to that 16.4% number?
There are two big ones, and they're converging. First, the 2017 tax cuts, which have helped boost corporate profits, are scheduled to expire. A return to higher tax rates will immediately take a bite out of that margin.
Okay, that's a policy risk.
And second, and this is maybe the bigger one, is corporate debt refinancing. The high interest rate environment is finally about to catch up.
Right, so much cheap debt was issued between 2010 and 2021.
Exactly. And all that legacy debt now needs to be rolled over. Companies are going to have to replace debt that cost them 1 or 2% with new debt at today's rates, which are often over 4%.
So interest expenses are going to spike.
They're going to double or triple for many companies. And when that happens, those peak 16.4% margins will face severe structural compression. The market is pricing in permanent peak margins, but policy and interest rates are both pulling them back down to earth.
Which brings us to the third defense, the intangible asset economy. The idea here is that market cap reflects hidden assets brands, algorithms, user networks, that things like GDP just don't capture.
Right. The market is valuing Google's search algorithm or Microsoft's network effect, not just the cost of their servers. And this intangible premium is real.
But it's also brittle.
It's extremely brittle. This whole valuation rests on the assumption of continued, unchallenged, almost monopolistic dominance, particularly from the Mag 7.
So if a leader loses its edge, or if regulators step in,
or if a competitor just leapfrogs them with a new technology, which is the whole story of tech disruption, that intangible premium can vanish. I mean, it can collapse almost overnight.
Okay, so the Buffett indicator tells us the market is overvalued relative to the size of the economy. Let's shift now to the second major gauge, the one that looks at profitability.
The Shiller P/E ratio, or KPE. This is where we look at whether the price of stocks is actually justified by their sustained earnings power.
So why do we need this cyclically adjusted PE, the KPE, instead of just the normal 12-month PE ratio that you see on the news every night?
That's the key question. A standard PE is just too volatile. It's prone to massive distortions. During an earnings peak, like the one we're in now with those 16% margins, the simple PE can look artificially low.
Making things look cheaper than they are.
Right. And then during a recession, earnings collapse and the PE can spike, making the market look expensive right at the bottom. The KPE is designed to smooth out all that noise.
How does it do that?
It takes the real inflation-adjusted price of the stock index and divides it not by last year's earnings, but by the average of the index's real inflation-adjusted earnings over the past 10 years.
So it captures a full business cycle.
A full cycle, recessions, recoveries, peaks. It gives you a much more reliable measure of the market's true normalized earnings power.
So what is that smooth, reliable metric telling us right now in late 2025?
It's screaming historical danger. The Shiller PE is currently at an astonishing 40.01.
40.
Just for context, the long-term average KPE, going back 145 years, is closer to 17. The average for the modern era is around 20.6.
So we're basically double the modern average.
We are. And that reading puts the market squarely in the 99th percentile of all historical valuations. Statistically, we are 2.3 to 2.4 standard deviations above the average. It's a true historical anomaly.
Let's talk about that 40 threshold. In all of market history, how many times have we seen a KP ratio above 40?
Only once before. It happened at the absolute fever pitch of the dot-com bubble. In December 1999, the KPE peaked at 44.2.
So we are right now testing the ceiling of the single greatest equity bubble in modern history.
That is exactly where we are.
And how does that compare to other famous market peaks?
They are all significantly lower. Just before the 1929 crash, the KPE was around 30. The peak before the 2007 global financial crisis, only about 27.
So returning to the 40 range is a huge statement.
It's a statement that investors are all in on the idea that AI has fundamentally, permanently altered the profitability of U.S. companies.
And what was the result of that 1999 peak, the only other time we were up here?
The result was a brutal lost decade. From 2000 through 2010, the S&P 500 delivered negative real returns. If you bought at that peak valuation, inflation ate up every penny of your nominal gains for 10 straight years. It's the simple gravity of valuation.
But the situation today is even more critical than in 1999 because of interest rates. For years, we had TINA. There is no alternative.
Exactly. Rates were zero, so stocks, no matter how pricey, were the only game in town. But that's over. Now, rates are high. There is an alternative.
So we need to quantify how much extra compensation investors are getting for taking on the risk of stocks versus just buying safe bonds. This is the excess cape yield, or ECY.
Yes, the ECY is the ultimate metric for risk compensation. Let's just run the numbers. First, you take the inverse of the CPE ratio, 1 divided by 40. That gives you an earnings yield of 2.5%. That's your expected real return from equities.
Okay, 2.5% from stocks. Now what about the safe asset?
We'll use the real yield on the 10-year Treasury. The nominal yield is about 4.06%. Let's assume inflation settles around 2.5%. That gives you a real risk-free return of about 1.5%.
So you can choose volatile stocks for a 2.5% real yield or lock in a 1.5% real yield on a risk-free bond.
Correct. So the excess yield, the risk premium, is just the difference. 2.5 minus 1.5 is 1%. Oh, wait. It's actually closer to 1.57% with more precise numbers. So let's use that.
1.57%. That's all you're getting paid for the risk. How does that compare historically?
The long-term average ECY is 4.61%. So 1.57, we are nearly 65% below the historical average.
What does that mean in plain English?
It means investors are pricing stocks as if they carry almost no risk, as if they're as safe as government bonds. There is no historical precedent for good long-term returns when the risk premium gets squeezed this tight. It signals extreme, dangerous complacency.
Now we have to be clear, the KPE is not a short-term timing tool.
Not at all. That's a critical caveat. In late 1996, the KPE crossed 25 and screamed sell, and the market then doubled over the next 3 years. If you use it for short-term timing, you'll get crushed.
So what is it good for?
It is exceptionally accurate at forecasting real returns over a 10 to 12-year horizon. Math eventually wins.
And what does the math say about the next decade, starting from a KPE of 40?
The historical data is pretty clear. When you start with a KPE above 35, you can typically expect 0 to 3% real annualized returns over the next decade.
Which is why Vanguard is forecasting just 4 to 5% nominal returns.
Exactly. They are telling you that the high starting valuation has to compress, and that compression is going to eat up most of your capital appreciation for the next 10 years.
Okay, so we've established the mathematical extremes. 224 on the Buffett indicator, 40 on the KPE. Neither is sustainable under normal conditions. The only force that could possibly justify this is the all-encompassing belief in AI.
Right. Is this a genuine revolution that repeals financial gravity, or is it just the classic narrative of a super bubble?
And this belief isn't just talk, it's backed by a truly massive amount of spending.
An unprecedented CapEx supercycle. Estimates are that cloud and AI infrastructure spending will exceed $1 trillion just between 2024 and 2026.
$1 trillion.
And that spending is happening right now. BlackRock even said that micro is macro now. The spending by just the Mag 7 is so huge, it's actually big enough to materially impact national GDP figures. Their investment choices are macroeconomic levers.
So the market is making a huge leveraged bet. What's the return that's priced in at 6850 on the S&P?
The bet is that this trillion-dollar investment is going to translate into an immediate, explosive, and very high-margin software revenue stream. It's pricing in flawless execution.
Which brings us to concentration risk. The whole thesis relies on a few companies executing flawlessly.
And that's the single greatest vulnerability. The valuation distortion is profound. The Mag 7 are priced for perpetual hypergrowth. But if you look at the other 493 stocks in the S&P 500,
The S&P 493.
they trade at much more moderate, though still elevated, valuations. So a problem for just 7 companies could sink the entire index, even if the rest of the economy is doing fine.
This is Bank of America's air pocket warning. Let's break down that mechanism.
The air pocket is all about timing risk. BofA warns that all this AI CapEx is a huge expense now. It's cash out the door. But the revenue, the return on that investment, might lag by 1, 2, even 3 years.
So the costs are hitting the income statement today, but the stock price is based on massive profits tomorrow.
Exactly. That's the mismatch. If there's any delay in that AI monetization, maybe customers adopt it slower than expected or regulators get in the way, the market's patience will just evaporate. The multiple on the Mag 7 collapses, and it drags the whole index down into that air pocket.
And this all depends on a perfect macroeconomic backdrop, too. A soft landing and a friendly Fed.
The whole structure relies on it. By late 2025, the Fed has a clear-cutting bias. Rates are in the 4.25 to 4.5% range, and the market is pricing in cuts down to maybe 3.75% by late 2026.
And lower rates justify higher PE multiples.
Absolutely. The lower the discount rate, the more valuable those far-off AI profits are in today's stock price.
But the Fed is walking a tightrope because inflation is still sticky.
That's the inflation trap. Core PCE is forecast to end 2025 at 2.5%, still above the 2% target. So if the Fed cuts aggressively to prop up the market, they risk reigniting inflation.
And if they don't cut?
If they hold rates high to kill inflation for good, they risk causing a recession, which would crush corporate earnings. Either way, the E and the DE ratio is at risk. It's a lose-lose for them.
And on top of all that, we have the slow drain of liquidity from quantitative tightening.
QT. The Fed has been shrinking its balance sheet from $9 trillion down to about $6.6 trillion. That pulls liquidity out of the system, and as Buffett puts it, leaves the market running on thinner fuel.
Which connects directly to the slowdown in corporate buybacks, right? The biggest buyer of stocks is stepping back.
It's a critical link.
Yeah.
QT makes it more expensive for companies to issue debt. And for years, they used cheap debt to fund massive share buybacks.
But now the debt is expensive, and they need that cash for AI CapEx.
Precisely. Buybacks slowed way down in 2025. Cash is being diverted from shareholders and funneled into building data centers. So you have a market with less liquidity facing the loss of its biggest buyer, right as valuations have peaked. That is a very dangerous mix.
So it's no surprise that the major Wall Street firms are completely split on what happens next. You have three very distinct camps for 2026.
Absolutely fractured. Let's start with the bulls, led by Morgan Stanley.
What's their take?
They're targeting the S&P at 7,800. That's another 14% upside. They're calling 2026 the year of risk reboot, meaning they think the AI boon is about to broaden out beyond just tech. They see a policy triumvirate, fiscal stimulus, Fed easing, and deregulation that will accelerate earnings growth to 17% in 2026. They're telling people to overweight small caps and cyclicals.
Okay, then you have the cautious camp, Bank of America.
Right. They're not calling for a crash, but they see a frustrating year. Their target is 7,100, so only about 4% upside. Their thesis is that multiple expansion is just done. The market needs to digest the headwinds.
The air pocket risk.
Exactly. So their advice is to play defense. Buy high-quality bonds and dividend growth stocks. Focus on income, not capital gains.
And then you have the bears, the mean reversionists.
This camp sees the 40x state PE and 224% Buffett indicator as mathematical guarantees of a bad outcome. Vanguard is in this camp, projecting just 4 to 5% annualized returns for the next decade. They're basically forecasting a lost decade.
And then you get the more extreme views like Jeremy Grantham.
Grantham at GMO calls this a super bubble. He thinks AI is just the classic displacement phase, the exciting new technology that justifies the final speculative blow-off. His firm is forecasting negative real returns for the next 7 years.
And the most extreme bear case.
That would be economist Harry Dent, who is predicting a catastrophic crash, wiping out up to 86% of the S&P's value as the entire post-2008 stimulus bubble unwinds. It's an outlier, but it highlights the stakes.
Okay, so this is the environment. Flawless execution is priced in. For you, the curious learner, the proactive investor, what are the strategic takeaways here? How do you navigate this?
The first, and maybe most important, is aggressive diversification outside of the U.S. The valuation gap between the U.S. market and the rest of the world is at a multi-decade extreme.
Can you quantify that?
Sure. The U.S. is at 24% market cap to GDP. Many large European and emerging markets are trading below 100%. The arbitrage opportunity is huge. International markets are either fairly priced or just plain cheap.
And that's also a hedge against the U.S. dollar.
A great currency hedge. If the Fed does cut rates aggressively, the dollar will likely weaken. Owning unhedged international assets gives you a tailwind as their local currencies strengthen.
Second big takeaway. The era of easy passive investing might be over.
Very likely. With the S&P 500 so concentrated in those few expensive Mag 7 names, this is the environment where active management could shine again.
So look for value outside the giants. In the S&P 493.
Exactly.
Right.
Morgan Stanley points out that small caps have lagged for years and are trading at recession-level valuations. They offer a margin of safety. This is about shifting focus from the stretched growth factor back to the value factor companies with strong free cash flow and low multiples.
And finally, bonds and alternatives are back in the game.
They're back in a huge way. For the first time in 15 years, high-quality bonds with a forward 4.5% yield are a legitimate alternative to stocks. They provide income, and they provide ballast. If a recession hits, bonds are where people flee for safety, which could drive their prices up.
And private markets.
Private markets offer a complete off-ramp from the public valuation problem. Vanguard recommends a 30% allocation for suitable investors. Why? Because private equity focuses on operational improvements, not just hoping the multiple expands. They forecast private equity will outperform public markets by about 3.5% annually for that very reason.
So to wrap up, this deep dive has really been about the core dissonance in the market. On one side, you have this relentless momentum, AI euphoria, and a price that demands perfection.
And on the other, you have the pure mathematical gravity of the Buffett indicator at 224% and the Shiller KP at 40. Numbers we've only seen at the peaks of the most devastating bubbles in history.
The final takeaway seems pretty clear.
I think so. The easy money era of just buying the index and watching it go up is probably over. The path forward requires a really careful balance. You have to respect the power of cyclical momentum. This could still melt up further.
But you also have to respect the structural gravity of these extreme valuations and the high probability of a lost decade for returns.
It raises a really important question for you to think about. If history has always shown that market prices eventually revert back to the underlying economy, Is the AI revolution really strong enough to repeal that law of mean reversion entirely? Or is it just delaying the inevitable and maybe making the final reckoning even more painful? Something to mull over as you watch the index level.
And as you do that, we appreciate you joining us for this crucial deep dive.
And if you want to track the total market temperature in real time, we do encourage you to search for and download the iOS app Buffett Indicator from the Apple App Store. It's a great tool to keep tabs on these daily fluctuations, and you can get the latest indicator reminders.
And if you find these explorations valuable and want to listen to our full deep dive about this topic or access even more advanced content, welcome to join our Deep Value Club membership. Or you can subscribe to us on Apple and Spotify podcasts. Just search for Deep Value Investing.
And as always, just a reminder that all the analysis we shared here is based on publicly available sources. It's for educational purposes only, and it does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.
We'll see you next time, and proceed with caution.